the yen carry trade unwind, what do you think are going to be some trickle-down effects or stepping stones that lead to a potential global mass adoption of these new payment rails?
For the last 20, 30 years, Japan has had almost zero interest rates. At some points, negative interest rates. So you could go borrow the yen, you could swap it for another currency through FX, and then go deploy that in other markets and earn money on your free money. And a lot of people park that in treasuries. Japan is the second largest holder of U.S. treasuries, $1.6 trillion in U.S. treasuries. The problem we have now is because of the inflation from COVID and everything else, they've had to raise interest rates there. Now, a lot of those loans coming due, or they've got to refinance, and they've got to do it at a higher interest rate. And now that we have our interest rates coming down and their bond yield continues to rise, they're going to have to eventually raise interest rates. You saw this start to unfold in August of 2024. We had 13% down in the S&P in one day. That is wild. And the Bank of Japan came out and they said, all right, we're going to hold interest rates while there's market volatility. We're not going to raise anymore. And they have. But now you have conflict in the Middle East. That is where they source most of their oil. Strait of Hormuz is a central choke point that all of their oil moves through. If they can't get oil, energy costs go up significantly, which causes more inflation, and they're going to have to raise interest rates. So when you see that happen, you're going to see a huge amount of treasuries flow onto the market. They're going to rotate into their own bonds. And luckily, in the last 2 years, we've passed the Genius Act, and the U.S. is now positioned to be able to soak up all of those foreign treasury bills that are going to flow back to the U.S. because the banks need them to be able to issue their stable coins that they're going to be using. So all those flow back to the U.S. There's going to be huge downward pressure on markets from other people unwinding those positions to repay those loans. You're going to have huge unrealized losses for the investment banks. They're already underwater. The only way they're going to be able to offset that, if they have an asset that were to appreciate substantially, they'd be able to offset those losses. And in order to be able to de-risk on the back end, I think the Bitcoin ETFs are going to play a big role in this. They absolutely have systemic risk at this point. You've got pension funds that have allocated. You've got many other financial products, sovereign wealth funds. I mean, anybody and everybody has made an allocation to the Bitcoin ETF at this point. And if you saw 50% down in a very short period of time, people are here to make money in markets. They're going to sell those positions. Right now, the back end of the stock market settles T+1. Bitcoin doesn't settle quite real time, like 45 minutes to get 3 verifications on chain. That's a lot faster than T+1. They're going to have to move to real-time settlement. And we had the president of NASDAQ was interviewed by Monica Long at Swell talking about the first place that they're going to implement distributed ledger technology is on the back end of the stock market for settlement and reconciliation for the DTCC between the clearinghouses and brokers. They already have it ready. And now the SEC's on board. We've got the Clarity Act right here in the near future. They're going to tokenize the stock market in the second half of this year, but that's the first move. And so when that happens, they're going to have to drive XRP's price to significantly higher price in order to be able to have enough liquidity to settle all of that on the back end. Also for a liquidity buffer for Japan. We've got the ETFs. There's going to be a supply shock. You're going to see a much higher price XRP in order to be able to facilitate those payment flows.